Let's imagine something for a second. You finally reach that magical milestone, $1 million saved for retirement. Feels amazing, right? You're probably thinking, okay, I made it. Maybe you picture yourself taking luxury cruises every year, flying business class whenever you travel, and spending your mornings on a golf course instead of in traffic. But before you start browsing yacht listings, we need to talk. Because what I'm about to tell you might deflate that dream faster than an overinflated beach ball at a kid's birthday party. Here's the reality most people don't expect. $1 million today simply doesn't stretch like it used to. 30 or 40 years ago, hitting that number could practically guarantee a comfortable retirement. But today, unless your retirement hobbies include clipping coupons and watching daytime reruns, you might need to adjust your expectations. Hey, I'm Vanessa, and I help people break down the confusing world of personal finance and retirement planning. If you want to understand what your money can realistically do for you later in life, hit that subscribe button and drop a thumbs up if this video helps clear things up. Now, here's something that surprises a lot of people. That $1 million retirement fund you've been dreaming about, it probably won't fund the luxury lifestyle you see in retirement commercials. In many cases, it might only support a fairly normal, middle-class retirement. So the big question today is simple, but incredibly important. How much income can a $1 million retirement portfolio actually generate? Before we crunch any numbers, let's talk about what most people assume retirement works like. A lot of people imagine something like this. You simply live off whatever your investments earn each year. Seems reasonable. If your investments grow by 10% one year, that's $100,000 you could spend. Not bad for doing nothing except letting your money sit in the market. But here's where that idea runs into a problem. The market doesn't move in a straight line. Some years are fantastic, others, not so much. One year your investments might grow 20%, and suddenly you feel like a financial genius. The next year your portfolio could drop 15%, and now you're staring at your account wondering what just happened. A good example is 2022, when markets dropped sharply, and many investors saw their portfolios shrink almost overnight. If your retirement plan depended on market gains that year, things would have gotten stressful pretty quickly. Imagine telling your partner that the vacation plans are canceled because the stock market decided to have a meltdown. And then there's another problem quietly working against you. Inflation. While you're celebrating your $1 million milestone, inflation is slowly chipping away at your money's value in the background. It's kind of like leaving an ice cube on the kitchen counter. At first it looks solid, but over time it melts away little by little. Think about everyday prices. 20 years ago, you could fill your gas tank for maybe $20. Today, that same tank might cost $60 or more, depending on where you live. That's inflation in action. And unfortunately, it keeps going, whether you're working or retired. So even if your retirement account still says $1 million, that money could buy significantly less, 20 or 30 years down the road. Because of this, financial experts have spent decades trying to answer a key question. How much money can retirees safely withdraw each year without running out later? And the answer isn't as generous as many people expect. Some advisors recommend withdrawing only 3% per year. If you have $1 million saved, that means about $30,000 annually. For many people, that feels pretty tight, especially if you're hoping to travel, dine out, or enjoy hobbies during retirement. On the other hand, some financial professionals say 5% withdrawals can work, particularly during strong market conditions. That would give you about $50,000 per year to live on. But most financial planners settle right in the middle, with something called the 4% rule. This rule has become one of the most widely used guidelines in retirement planning. And no, it wasn't pulled out of thin air. Researchers looked at decades of historical data from both stock and bond markets to see how much retirees could safely withdraw without running out of money. The result was surprisingly consistent. With the 4% rule, you withdraw 4% of your portfolio in the first year of retirement, and then adjust that amount each year for inflation. So if you start with $1 million, your first withdrawal would be about $40,000. If inflation runs at 3% the next year, you'd increase your withdrawal to around $41,200 to maintain your spending power. The goal is for your savings to last roughly 30 years. But before you start planning how to spend that $40,000, there are a few important details to understand. First, the research behind the 4% rule assumes your investments are split roughly half in stocks and half in bonds. That's considered a balanced portfolio. Stocks provide long-term growth, while bonds help stabilize the portfolio when markets get rough. The mix matters. More stocks can lead to higher returns over time, but also bigger swings in value. More bonds usually means lower risk, but also slower growth. Younger retirees often hold more stocks because they have time to recover from market downturns. Older retirees may shift toward bonds to reduce volatility. Another important detail many people overlook is the retirement timeline. The 4% rule was designed around a retirement lasting about 30 years. If you retire at 65, that might be reasonable. But if you retire at 50, your money might need to last 40 years or longer. And that means you may need to withdraw less each year. Longevity is one of the biggest wild cards in retirement planning. According to recent data, a typical 65-year-old today can expect to live around 18 to 20 more years. But remember, that's just an average. Many people live well into their 90s. So it's entirely possible your retirement could last 3 decades or more. Planning conservatively helps protect against that risk. Now, let's go back to that $40,000 annual withdrawal. At first glance, that number might feel a little disappointing. After all, $40,000 doesn't exactly scream luxury living in today's economy. But here's an important piece of the puzzle. That probably won't be your only retirement income. Most people also receive Social Security benefits. Right now, the average Social Security payment is roughly $1,800 per month, or about $21,600 per year. Your actual benefit could be higher or lower depending on your earnings history and when you decide to claim it. If you claim early, your benefit is smaller. If you wait until full retirement age, or even age 70, you receive larger monthly payments. When you combine Social Security with a $40,000 withdrawal from your savings, your total retirement income could reach roughly $60,000 per year. For married couples where both spouses receive benefits, that number could climb closer to $80,000 annually. And suddenly, that million-dollar nest egg starts looking a lot more reasonable. Of course, there's one more detail we can't ignore: taxes. If your retirement savings are in accounts like a 401k or traditional IRA, withdrawals are taxed as ordinary income. But if your savings are in a Roth IRA, withdrawals are completely tax-free. Most retirees end up with a mix of different account types, which actually gives them flexibility when managing taxes. And that flexibility can make a big difference over time. So, what does all of this mean? $1 million in retirement savings might provide somewhere between $40,000 and $60,000 per year, especially when combined with Social Security. It's not private debt money, but it's definitely not instant noodle survival either. The key is understanding what that number actually means and planning your lifestyle around it. Because the best retirement plans aren't built on wishful thinking. They're built on real numbers and smart expectations. And with the right strategy, a comfortable retirement is still absolutely within reach.